So, hello everyone. So, for today's topic will be about the pricing, and this is Russell Yagas, the one who will report about this topic. Let's proceed. So there are various ways retailers calculate price. So number one is contribution margin. It represents the incremental money generated for each unit sold after deducting the variable portion of the company's costs. It is calculated as the selling price per unit minus the variable cost per unit. So this contribution margin is one of the ways retailer calculate price. And the other way is break even analysis. So it is a calculation that weighs the cost of a new product or service against the unit selling price to determine the point at which you'll break even. So to calculate the break even point, use the following formula. So the lower part is the formula used um, to the break-even analysis. So its break-even point equals the fixed cost divided by the sales price minus the variable costs. So that's how they price or they give price to their product when it comes to break-even analysis. And let's proceed to number three. So number three is open to buy or OTB is calculated as follows. So I have only here the formula used in open to buy kind of ways a retailer give price to their product. So planned sales plus planned markdowns plus planned end of month inventory minus the beginning of month inventory. So let's not go deeper with the math. Let's go to the next. So the next one is calculating markups based on retail and cost. So to calculate the markups based on the retail price and the cost, you can use the following formula. So markup is equals to retail price minus the cost divided by the cost. So let's proceed for the example. So on the next slide, we can see the example here. So let's go through an example to illustrate the calculation. So suppose you have a product that costs $50 to produce and you want to set a retail price of $80. So to calculate the markup, you can use the formula markup is equals to $80 minus $50 over 50 dollars. So markup is $80 minus $50 is $30 divided by or over 50%. If $50, so the markup is 0.6 or 60%. So in this example, the markup is 60%. So this means that the retail price is set 60% higher than the cost of the product. So remember that the markup represents the percentage of profit you want to make over the cost. So it's important to consider other factors such as market demand, competition, target profit margins when setting the retail price of a product. Okay, so let's proceed to the next topic rather. So calculating markdowns. So kanina we tackled about markups. Now let's talk about markdowns. So to calculate markdowns, you need to know the original price of an item and the percentage discount being applied. So the formula to calculate the markdown amount is as follows. Markdown amount is equal to original price discount percentage over 100. And to calculate the final sale price after the markdown, you subtract the markdown amount from the original price. Sale price is equal to original price minus markdown amount. And then, so here's an explanation to illustrate the calculation. So, let's say you have an item with an original price of $100 and a discount of 20%. So, the markdown amount is $100, then 20 over 100, so it's equal to $20. So sale price is $100 minus $20 is equals to $80. So after applying a 20% markdown, the sale price of an item would be $80. So that just keep in mind that this calculation assumes a simple percentage discount. So if you have no more complex pricing structures such as multiple markdowns or discounts applied to different components, the calculation may be different. Okay, so let's proceed to the next topic. So our next topic will be about price lining. So price lining is a pricing strategy where products or services are grouped into specific price ranges or categories. So rather than setting individual prices for each product, a company establishes a limited number of price points, also known as price lines, so within a particular product line or category. So the purpose of price lining is to simplify the pricing structure and provide customers with clear options at different price levels. So it helps customers quickly understand the value and features associated with each price point, making their decision-making process easier. So price lining also allows companies to target different customer segments with distinct price sensitivities. So in the next slide, okay, here's an example of price lining in action. So imagine a clothing store that specializes in men's shirts. So they have three price lines for their t-shirts or their shirts: economy, standard, and premium. So economy line is our shirts are priced at $20. Standard line, shirts priced at $40. And premium line, shirts priced at $80. So, by implementing price lining, the store is offering customers choices based on their preferences and budgets. So, customers looking for affordable options can consider shirts from the economy line, while those seeking higher quality materials and craftsmanships might be interested in the premium line. So, the standard line offers a balance between price and the features. And on the next slide, okay, so price lining can also help companies create an image of exclusivity and prestige associated with higher priced products. So customers may perceive the premium line as a symbol of luxury and superior quality, reinforcing the brand's positioning. So it's worth noting that the number of price lines and the price differentials between them can vary depending on the industry, the market conditions, competition, and the company's pricing strategy. And price lining is a flexible approach that allows companies to tailor their pricing structure to suit their target market and business goals. On the next slide, okay, there are various laws that affect retail pricing. So there are several laws and regulations that can impact retail pricing. Here are some of the key laws that affect retail pricing. Number one, price discrimination laws. So price discrimination refers to the practice of charging different prices to different customers for the same product or service. So, this is somehow yung mga tao or yung mga common situations in a retailer because some are there, tinatawag nating suki, 'di ba? So, sometimes they offer other amount to their suki and to just simple customer. So, sometimes may mga ano talaga, may mga discrimination or yung hindi balance na pagbigay ng pricing ng mga retailers. Next. So number two is minimum pricing laws. So some jurisdictions have laws that establish minimum prices for certain products. So these laws aim to prevent predatory pricing practices and maintain fair competition. So minimum pricing laws may apply to items like alcohol, tobacco, pharmaceuticals, or gasoline. So these kinds of products are somehow more likely nga mga needed ng mga tao. So that's why the politicians or the politics are giving this law para naman na mangin fair sa mga tao na hindi kaya o hindi kayang bayaran yung isang product which is they needed every day of their life. So next one is the competition laws. So competition laws, also known as antitrust laws, are designed to prevent anti-competitive behavior in the marketplace. So when we say naman na competition laws, these laws regulate various aspects of pricing, including price fixing or colluding with competitors to set prices, market allocation, and abuse of dominant market position. So let's proceed to the next slide. So this is about naman on the retail evaluation and control. So this is the second topic that I will be tackling. So next slide. The different measuring techniques for retail success. So there are several measuring techniques that retailers use to assess and track their success. These techniques help retailers understand their performance, identify areas for improvement, and make informed business decisions. On the next slide, we can see some commonly used measuring techniques for retail success. Number one is sales and revenue metrics. So these metrics focus on tracking sales and revenue generated by the retail business. So key metrics include total sales, sales growth rate, average transaction value, average basket size, and sales per customer. So these metrics provide insights into the overall financial performance of the retail. Number two is customer metrics. Customer metrics help retailers understand their customers' behavior and satisfaction. So on number two naman, key metrics include customer acquisition rate, customer retention rate, customer lifetime value or CLV, repeat purchase rate, and customer satisfaction scores such as the Net Promoter Score or NPS. And these metrics provide insights into customers' loyalty, engagement, and the effectiveness of marketing and customer service strategies. And the number three is inventory management metrics. So this inventory management metrics focus on optimizing inventory levels and supply chain operations. So with regards naman sa kay number three, the key metrics include inventory turnover ratio, sell-through rate, stock to sales ratio, and carrying costs of inventory. So these metrics help retailers ensure that they have the right inventory levels, minimize stockouts, and reduce holding costs. Next naman is number 4, the profitability metrics. So profitability metrics assess the financial performance and profitability of the retail business. So kay number 4 naman is that number 4 key metrics include gross margin, which is revenue minus the cost of goods sold, and the operating margin, which is the operating income as a percentage of revenue, the net profit margin, and return on investment or ROI. So these metrics help evaluate the overall financial health of the business and its profitability. And lastly is number 5, market and competitive analysis. So market and competitive analysis involves monitoring industry trends, market share, and competitor performance. So when it comes naman sa number 5, this includes tracking market size, market growth rate, customer preferences, and competitor pricing and promotions. So market and competitive analysis helps retailers identify opportunities, understand consumer demands, and stay ahead in a competitive market. And in the next slide, okay, we will tackle the last topic, which is DPP or direct product profitability. So when we say direct product profitability or DPP is a financial metric used by retailers to determine the profitability of individual products or SKUs, which is stock keeping units. When we say naman DPP, it helps retailers understand the financial performance of each product by considering the direct costs associated with its production, procurement, and sales. And also, DPP takes into account both the revenue generated from the sale of a product and the direct cost associated with that product. So it provides a more accurate picture of profitability compared to gross margin, as it factors in all relevant costs directly attributable to a specific product. And next, okay, to calculate the direct product profitability, the following components are considered. So number one is revenue. So this is the total sales revenue generated from the product, typically calculated by multiplying the selling price by the number of units sold. While number two naman is COGS, or the cost of goods sold. So it includes the direct cost incurred in producing or procuring the product, and it encompasses factors such as the cost of raw materials, manufacturing or production costs, packaging, and direct labor costs. And number three is about direct selling cost naman. So these are the costs directly associated with the sales and marketing of the product. So it may include expenses such as advertising costs, sales commissions, packaging, and promotional expenses specific to the product. And number four is direct operating costs. So these are the operational costs incurred in relation to the product, such as warehousing, distribution, transportation, and inventory holding costs. Okay, let's proceed to the next slide. Okay, this will be the last topic that I will tackle, or the last slide. So once these components are determined, which is those four, the direct product profitability can be calculated using the formula. DPP is equals to revenue minus the COGs, or the cost of goods sale, plus direct selling cost plus direct operating costs. So, by calculating the DPP for each product, retailers can gain insights into the profitability of individual products and make informed decisions regarding the pricing, product mix, the promotions, and inventory management. It helps retailers identify products with higher profit margins and optimize their product offerings to maximize profitability. And that's all for my report. Thank you for listening, and bye.